Welcome to the Ellsworth Advisors monthly update for June of 2023. I'm Kelly Keenan, and this is Patrick Justice. He'll be taking the place of Cameron Mealy today. So what we'll go through is the latest economic numbers, how our portfolios have been doing, and kind of our thoughts as to what to expect over the next month or so. So Patrick, why don't you kick it off with some of the latest economic data?
Sure. Thanks, Kelly. Happy to be here. Good morning. I'd like to take a little different approach to our start today with recent news that the Supreme Court ruled against the Biden student loan forgiveness system. Certainly could be tough for some of our younger clients and certainly children of clients as well. So unless additional legislation comes out, student loan payments are set to start in the fall. So the interest and the clock will start running in September. Payments will kick in October. So people have gotten used to not paying here for 3+ years. Just want to bring that up for people, as I think it affects a lot of people in this country, and you probably know somebody that's going to be affected by that. So at this point, we advise you to at least log into your servicer, verify where your loans are, what are the rates, what's going to kick back in, just so you're prepared for the fall.
Absolutely. They have changed they're talking about changing some of the rules on how much you have to pay. So there's some adjustments going on in that world. Once again, more outflows and potentially a slowdown to the economy. Putting in the grand scheme of things, I think a little too soon to tell how much that's really going to affect the big picture, but on a individual basis, this is a reality that is happening throughout the country, and will be happening in the fall. That's for sure.
Absolutely. Well, let's jump into the economic data. As most expected, the Fed did decide to pause the rate hike in June, so they sit at 5 to 5.25 right now for their target rate. Fed Chair Jerome Powell did reference just how aggressive they've been, bumping by 5% over the course of the last year. Makes sense when you think about it. They came out of the gate when they realized they had a problem with inflation. Went 75 bips multiple times, dropped down to 50, dropped down to 25, and I think they just want to take a peek at some more economic data, get a feel, and just pause this time. Now, when they meet again in July, I think most people are expecting they have to get back on the wagon and continue to bump. The median Fed participants are projecting they'll be at 5.6 at the end of the year. So they sit at 5 to 5.25 right now. I think that basically, they have to bump at least a couple more times. We'll see where data comes in, but they're going to have to get back to bumping rates.
That's a lot of Wall Street's kind of come to that conclusion. They'll bump again in July, just because the economic numbers are not coming in that bad. They're still, I would call them soft, but mixed. I think we've talked about this in previous months, where some of the economic numbers are good. Unemployment still is at good levels. The employment rate from ADP came out pretty strong today. Now the caveat being there, they've changed some of their calculation methods, so how easy is it to compare those numbers? But then again, they're not horrible, and they actually came out pretty well. So the expectation is, another bump in July, and already hearing rumblings about a potential another bump in September. So, to see maybe 6% on the Fed funds rate, which was nobody was expecting 3, 6, 9 months ago. It's starting to come that we could see 6% on short-term interest rates, which will be very interesting. Longer-term rates today, we hit just over 4% early this morning on the 10-year Treasury, which we hadn't seen since last October. So you're getting a little bit of pressure on the longer-term rates too. Once again, it's all about kind of trying to bring down the inflation rate, which, we're well off the 8-9% level that we saw last fall. Now we're more in that 4 to 5% level. But to keep on going is going to be, to keep it coming down is going to be difficult, and to get to 2%, I think, is going to take quite a long period of time.
Yeah, I agree. Speaking inflation, according to the Bureau of Labor Statistics, all item CPI rose 4% for the 12 months ending in May, with core inflation, which excludes volatile food and energy prices, rising by 5.3%. So we are coming down a bit. Certainly a bit of progress, because it was the smallest 12-month increase since March of 21. So that is positive. The rate hikes and the tightening is working a bit. Now, I will point out something very interesting, where shelter represents 42% of that core CPI. I dug into that a little further, and shelter represents essentially rents, traditional rents, and also what it would cost you to rent your home if you weren't a homeowner, right? And so in reading that paper, it talked about how those numbers and those shelter numbers can lag.
Right.
So that gives me a little bit of hope, thinking we're at 5.3 core inflation. If rental contracts are typically 1 to 2 year deals, if they lag, maybe it's a little better in a real number when that's comprising 42% of that figure that's still they're working on. It gives me some hope as far as what they're trying to do.
Right. No, I think they are making progress. And, on the housing front, we're seeing the increases in rents, that decelerate a little bit. They haven't, rents haven't come down, but the amount of increases has slowed.
Yep.
Housing still, we're in a situation from a housing standpoint where demographically demand is outstripping supply. And then with higher interest rates, the other thing that's happening is people are a lot more reluctant to sell their houses if they're already locked into a 2-3% mortgage.
Where are they going to go?
Which,
right.
Very few people did variable mortgages over the last several years. So a lot of people are locked into real low interest rates.
Yep.
To go from a 3% mortgage to a 7% mortgage. That may incline you to kind of stay put. So, there is some stress in the housing market from that standpoint. In that, I don't see prices coming down very much. I mean, nationally they've softened, but once again, real estate's all local, and in a lot of places you're still seeing prices going up from a selling standpoint. I know we see with our clients that puts our houses up for sale. I haven't had a client sit on a property for more than a couple of weeks. Any client that's been trying to sell their houses, they've gone, and either at asking, maybe a little above asking, not much below asking. So, it's I think there's still going to be some pressure there. Is there room to get inflation down off from 5 to 3? To get down to 3 in the 3s in the next 12 months, I think is very possible. That 2% number the Fed's looking for, I think, is still a ways out. So, we are looking at a little higher interest rate environment, and inflation's going to be with us for a while.
Agreed. Let's talk growth for a minute. GDP numbers, according to the Bureau of Economic Analysis, third estimate of quarter one is now out at an annual rate of 2%. So a slight increase from the previous two figures. Very fresh number from July 3rd from Atlanta Fed GDP now sits at 1.9% seasonally adjusted annual rate. But I will say, in watching the recent Fed comments, the committee is still at a 1% annualized growth rate for the year. So you get these numbers from the first quarter, second quarter coming in, they're thinking 1.8, 2 and change is where they were. Fed's still at 1. I'm reading into that to thinking that, look, they know they have to continue to tighten. They're going to have to continue to bump. They think it's going to be a little rocky end of 2023.
Well, that's where you kind of look at the conflicting economic numbers that are out there. So we're always looking at GDP, which is gross domestic product. You look at GDI, gross domestic income, which typically they run neck and neck, and they're almost the same thing. The reality, when you actually look at GDI, gross domestic income, those numbers are actually gone slightly negative. So, the Fed, they're looking at both sides, and that's probably what's driving their estimates a little bit lower. I think it was Germany, they had a negative first quarter, so you're definitely seeing some softness in Europe. And the other leading economic indicator that's kind of been showing signs is more of a survey, the PMI survey. Typically a reading above 50 really represents more economic expansion. Below 50 represents more contraction. And the reality is that PMI survey has been negative, I think, for the last 9 or 12 months consecutively, in the 40s. So, the Fed's looking at all this data. So, okay, yeah, we're coming in at not 1.9. But you have other indicators showing maybe slight recession, or we're maybe already in softness phase. So that explains why they're thinking more 1%, but we haven't seen it. Once again, we're in a very dynamic, diverse economy, and the message I take is, yeah, things have slowed down. Things are a little soft. They're not horrible. They're definitely not, we're not in boom phase. We're not, growing leaps over bounds, but just kind of, I'll use the term muddling through, and that's kind of the track that we've been on, and we very well could stay in that type of mode for a while.
Yeah, you bring up recession, and it's been a hot topic for the last 3+ years. One tidbit, I was at an economic forum a couple weeks ago and talking about the yield curve inversion. So where the 2-year is paying a higher rate than a longer bond, the 10-year, so the 2's higher than the 10. And everybody thinks as soon as that happens, boom, you're right into recession. Not the case. Historically, it's typically a 12 to 18-month leading indicator that then you get into recession. Well, that was July of 22.
So
we now sit in July of 23.
Exactly.
So it makes a lot of sense. All the other factors, we have rate hikes coming in, GDP numbers slowing, et cetera, and you get a little indicator leading in. I think it certainly makes sense we're not in the prognostication business exactly, but we want to get a feel for where we're going. That 12 to 18 month window makes a lot of sense for end of the year, beginning of 24.
And bottom line, what that means is we just want to stay prudent with our investments.
Yep.
Stick with fundamentally sound companies. In this type of environment, it's the market's not uniform. We've been in those, the last several years, we've been in phases where just everything goes up. I think, market participants are a lot more selective now in what's working, what's not working. And as risk managers, even in our more aggressive portfolios, we still have that eye to the downside.
Yep.
And we always want to know that if all hell breaks loose and things fall apart, our fundamentals are still sound. So, that's always been our approach, because, it's not about beating the index. It's about getting our clients to retirement, preserving their capital, maintaining their capital, growing, faster than inflation, and being able to provide for the future. And that means, in our worst case scenarios, we want to make sure we're in sound investments, and that continues to be our approach, and will continue to be. In the shorter term, we had a great month in June, and it was kind of in my write-up for May. The thoughts were, we had a select group of stocks kind of driving things, kind of the biggest tech stocks, seven largest stocks, kind of driving the index in May. And the thoughts were either the rest of the market may catch up in the short term, or those tech stocks have maybe become more susceptible to a pullback. And the reality is June, we did see a broadening out. We saw more participation across the board, so more of a catch up. And the market's been in a kind of a trading range. We kind of broke above that range, with the rest of the market kind of catching up a little bit. So that was a good sign, and I think that's going to give us maybe a little bit of a downside protection. I'm still in the mindset that we probably saw the worst of the downside of the market last year. There's always the chance of revisiting it. I don't see it getting much worse than anything we saw last year. But in the short term, it just seems like we're going to continue to muddle through, and the market kind of churn around. We've had a positive bias, especially through June. We have to expect some pullbacks. That's kind of how, it races up, pulls back. But I don't see any big dislocations in the short term. And once again, it's kind of we got to think about maintaining. Make sure we have the right liquidity for our clients' needs. When they need dollars, they're available. We don't have to sell at lows. But I just think, I'm expecting kind of a boring summer. And, boring is fine after the start of the year. And, jumping into the indexes. So, talking about, what happened last month and year to date, S&P 500 for the month up 4.05%. Year to date, just under 16% at 15.95. The Dow last month up 1.94, continues to be the laggard when you think about U.S. stocks. Like I said, up 1.94. Year to date only up 3.93. That's because the exposure to those stocks that have driven things is a lot heavier. On the NASDAQ, which really, that's where the concentration of those big large tech companies is. For the month up 4.35, year to date up 31.26. So, or I'm sorry, 32.66. Now they had a horrible year last year, but you look over 3 years, you're still leading the pack. Small company stocks last month. Small company stocks always very volatile, showing some signs of life in the last month, up 3.16. Year to date up 7.24. On the international front, 1.62 for the month, not great, not bad. Year to date though, kind of sneakily up there at 9.66, so showing some signs of life. Emerging markets, they've been a laggard. They're always very volatile. You've had some firms that have been pounding the table to buy more emerging markets the last 2 years. I haven't bought into that theory at all. Last month up 0.52, year to date up only 3.46, and the emerging markets, I believe that you really need the rest of the world to be doing pretty well for them to really do well. And obviously China hasn't really broke out. They have not met expectations with the China reopening. Mm-hmm. They have been slow to reopen. You have an economy that large, that many people. Yep. You can't turn a ship that quickly, and it's a big ship to turn. So, that's definitely been weighing on the emerging markets. But you also see some good things happening in other areas, whether it's India or South America. From a portfolio standpoint, our growth with income portfolio for the month up 4.7% for the month. Year to date 7.6, so that's pretty respectable for more of a balanced portfolio. Big gainers. Nucor last month up 25%, so steel producer, that's a good sign. Nvidia, the gift that keeps on giving, up 12% last month. Nike, which had some struggles last year and early in the year, up 19%, so they had a nice bump there. Mm-hmm. I think part of that's probably just China reopening, because Nike being a coveted brand around the world, that's definitely helped them. And then Lennar, talking about housing, home builder up 17%, so home builders have been strong. Laggards last month, our IDX, our commodity strategy fund, down 2.5%. Our real estate position, XLRE down 2.9, gold down 2%. So kind of like the hard assets last month. Right. Did not work at all. Favor. Not at all. Year to date, Nvidia still up 189% year to date. We did some shaving there, kind of brought us back down to portfolio weight levels in Nvidia. Still hold it, but we want to take those gains while we have them. That's the second time we've shaved there this year. Apple up 50% year to date, so nice run by Apple. Apple still looks good, and once again, Lennar up 39.5%. So we like what's going on in the home builders. Yet laggards, PIMCO commodity, down 8.4. J&J down 5%, and then EOG, our natural gas energy producer, down 9.6. So you're seeing a little bit of shift of what's been working. In our dividend yield portfolio, June, big month there. We had a lot of catching up to do, up 6.2%. For the month. Year to date, only up 2.3% year to date. Big gainers, Caterpillar up 20, Eaton Corporation up 14, U.S. Bank up 12, Blackstone up 8.6. Laggards, Pfizer was down for the month, down 3.5. Con Ed down 3%. Year-to-date gainers, Eaton now up 24.9, Blackstone 27.7, Merck up 14.5. Year-to-date laggards, unlike Merck, Pfizer's down 20%, 20.5. They may have, got ahead of themselves during COVID. Obviously, giving them a little bit back here. 3M down 14, and Alliant Energy, down 3.4. So the most defensive areas are lagging, but once again, it's a little more selective. You look at healthcare, Merck up, Pfizer down. Okay, yeah. As a whole, maybe the industry's down, but you can still find good performing stocks, and it comes down to what individual companies are doing, how they're handling the higher interest rate environment.
And they're plodding along.
Yeah, exactly.
Yeah, paying healthy dividends.
Our appreciation with income portfolio, this is a newer portfolio. We don't have a lot of people in it yet because it is so new. June, we're up 2.5, year to date up 6%. Big gainers, Dell up 20%, Lamar Advertising up 12, Broadcom up 8. Laggard, Shell was down 0.8%. That was really the only laggard last month in that portfolio. Year to date, Broadcom up 56%, Dell up 37. Restaurant brands, things are happening in the service sector, up 22%. Sanofi up 15%. Price potential, one of our more large cap, more aggressive portfolios. Don't have a ton of tech in there, but June we were up 7%. Year to date we're up 9%. Big gainers, Fox Factory. We just picked this up within the last, maybe early last month, up 22%. We made good money in there last year. We sold it, bought it back again, so we're off to a good start with Fox Factory. Gibraltar Industries up 20%, Lululemon up 14%, another new buy, and then Fiserv up 12.4%. Big laggard in June was Humana, down 10.7%. Once again, the healthcare situation. Year-to-date, FleetCor Technologies up 37%. And these are things that are still in the portfolio. Gibraltar up 37%, Fiserv up 25%. In the portfolio, our big laggard for year-to-date is Genpact that we still hold on to, down about 18%. Price potential. Our small cap price potential portfolio. June up 3%. Year-to-date up only 1%. Like I said, small cap struggling a little bit, but we did have some big gainers in June. UFP Industries up 25%. Alpha Metallurgical up 22%. Sterling Infrastructure up 21%. Some nice gains there. No big laggards. Lantheus only down 3%, but Lantheus, we're up year-to-date 65% in there, so we gave up about 3% last month. Unitil down 3.8%. PTC Pharmaceutics down 3%. Once again, big gainers that we're still sitting on. Performed line products up 89%, and Lantheus up 65%. Laggards still in the portfolio. Titan Machinery down 25%, and White Mountain Insurance down 1.7%. So, a decent month. I'd say a good month last month. Year to date, we're kind of where I'd expect to be, knowing what we're holding. And like I said, I kind of see more just kind of churning around for the, for July, August. I think we probably eke out some gains, but I'm not counting on it. I think we just kind of take what we can get, stay fundamentally sound, and go from there.
I'd be curious to see if we start, I know our traders have been talking about lengthening duration a little bit, start peaking down the curve a bit. I know it's maybe a touch early for that, but if we can find the right quality names and grab a little bit more than those short treasuries, it's something we're starting to look at.
We're starting to look at it. We're still able to, by staying short, we're still in that 5 to 6 range. If we get a bump from the Fed in July, we might be able to get some 6%. Treasury paper, we'll take that in the short term and kind of wait and see what shakes out on the long end. I'm just not, I don't know if that longer end at 4%, if that's going to kind of be where the 10-year shakes out, or if there's a little bit more upside. That's the big wild card. And if we can get 5 or 6, we can always go out longer when the time comes. If we're getting it now, time value of money sometimes says take as much as you can in the short run, and we'll see what's happening on the longer end of it.
Absolutely.
Anything else you want to add?
Good. Happy to be here again.
Well, that's our monthly update for June. If you have any questions or want to discuss your accounts, please reach out to us, and have a great summer. Thank you.
Thank you.